Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice. In this edition of the podcast, I have a chance to talk to Richard Stone, who is the Chief Executive of the Association of Investment Companies, the industry lobbying body. Of course, it's a new year, Richard. It's always a time when we look forward, but also look back. So before we get into some of the topical issues, not excluding cost disclosure and Saba capital and requisition meetings and all those good things, which we will talk about, let's just quickly get your view on how 2024 unveiled for the investment trust industry.
It's good to talk to you again, Jonathan, and thank you for the opportunity. 2024 was an extremely busy year. I think there's a sort of few headlines to look at, I suppose, in terms of the sort of broad economic backdrop, and the investment company sector doesn't operate in isolation. It was one of quite challenging times for investors. Interest rates remained relatively high, and you saw significant outflows from the market, and you can see that in some of the open-ended data. The consequence in our sector was that the average investment trust discount remained relatively high. If you exclude 3i, it ended the year at about 15%. And what you saw during the year was really boards responding to that and being very active, trying to deliver value for shareholders. So we saw records being set in a number of different areas. We saw record levels of mergers. There were 10 mergers completed in the year between investment trusts. That was double the previous record of 5 in a year. And obviously the largest of those was Alliance Witten, who then went on and joined the FTSE 100. So brings to 5 the number of investment companies within the FTSE 100. We also saw record levels of share buybacks, about 7.5 billion of shares repurchased in 2024. Again, close to double the previous record, which was 3.9 billion in 2023. And we saw high levels of dividends still being paid, 6.5 billion of dividends being paid out. And actually funds in the sector, total assets under management, increased slightly to 266 billion, which in the face of all those buybacks and dividend payments and mergers and things, was actually a function of good performance. And the average investment trust delivered a total share price return of 13% in 2024, which I imagine investors were reasonably pleased with. So much to do in terms of the discounts, which remain at extended levels, but you can clearly see the action that boards have been taking during the course of the last year.
So we have seen the number of investment trusts reduce, as you've already noted, and it seems to be widely held view, certainly in the communities I talk to, brokers and analysts and so on, that further consolidation is still going to happen. Is that a view that you would share?
I think when you look at sources of demand, if you like, then there is pressure to have larger, more liquid vehicles, and I'm talking about the investments themselves, not the underlying assets, larger vehicles with greater liquidity. That's being driven by consolidation in the wealth management sector, the potential desire of pension funds and others to come in and invest in UK equities. They want to have larger companies to invest in. And as I said, you can see the sector responding to that pressure. The 10 mergers that happened last year, as you rightly say, the number of investment companies has declined in the last 12 months, but the assets within the sector haven't. The mathematical outcome of that is the average size of an investment company is increasing quite significantly over time, really responding to that demand from investors to have those larger vehicles. So is that trend going to continue? I can't see anything at the moment that's changing that from a demand perspective. So I would expect that there will probably be more activity along those lines, particularly as discounts remain relatively wide and boards are looking at ways of delivering that shareholder value.
I think it's fair to say that if you look at the discount, obviously 3 years ago, the average discount was just pretty close to 2%, I think, and now it's 15%, and it's been slightly wider at one point. So it has been very persistent. It's been 3 years now that we've seen this significant widening of discounts, and so far, for whatever reason, it hasn't changed materially from the low point. If we go back in history, though, we look at investment trusts, typically you would expect investment trusts most of the time to trade between around 5 and 10%, depending on the kind of asset class they're in and the record they have. So it's probably unrealistic to expect the average to go back towards par, would it not be? But maybe some improvement is still possible, or is this something we're going to have to learn to live with?
think some improvement is undoubtedly possible. I think you've also got to be a little bit careful when looking at averages, because I think historically, as you say, when you look back in time, the sector has had periods of widened discounts. They've typically lasted up to about 2 years and then come in. This one seems to be lasting a bit longer. But actually, when you look back in time, historically, a lot of the sector was invested in other listed equity. And when you split the sector as it is today into those investment companies that are invested in other listed equities, the sort of more traditional mandates, if you like, versus the alternative asset investment companies that are perhaps invested in infrastructure, real assets, renewable energy, those sorts of areas, the discount picture is quite different. So the equities mandates, yes, they've seen their discounts widen a bit, going a little bit beyond or pushing that 10% that you were talking about in terms of that historic sort of range. But it's those alternative asset investment companies that have seen their discounts really widen significantly. And that really chimed with the switch that we saw in interest rates. And you can map those two things against each other. As we see interest rates come in, then those companies where they're providing yield and things that will potentially help in terms of narrowing some of that discount. But I think you've got to be a little bit careful when looking at averages, because there is a distinct difference, I think, between those two areas of the broader investment company sector for investors to look at and consider.
I suppose the worry about the alternatives is this, that nearly all the alternatives, apart from the traditional classes such as private equity and commercial property, they've all emerged on the back of the global financial crisis and a zero interest rate regime. At the moment, interest rates, as you say, remain where they are. Hopes that they would come down have faded, I think it's fair to say, and since Trump's election, they've perhaps faded even more. Do you think that there is potentially some kind of existential crisis for these other newer alternative asset classes, which aren't able to raise new equity anymore and are facing potentially a regime where they have not only higher interest rates to deal with, but also some other factors we'll come on to, like cost disclosure?
And undoubtedly, it's not just interest rates. There are other factors that have driven some of those discounts widening as well. But no, I don't think there's an existential crisis in that sense. I think there is an opportunity as interest rates come in for those trusts to get back closer to net asset value. And there's opportunities there for investors. And I know we're going to talk a little bit about Saba in a minute as well, but some of the activist investors are seeing value opportunities there and things as well. And other investors will too. I mean, ultimately, it's a balance between supply and demand. And as I said, the investment company sector doesn't operate in isolation. And where you've seen significant outflows from the market, from UK equities, etc., and all of those things have driven these discounts. And ultimately, there's an opportunity for those things to reverse and come back in again. I mean, I think if you take a step back and you look at the broader picture, you're right that the budget in the UK, as well as Trump, definitely fueled expectations that we're potentially facing higher inflation and therefore higher interest rates for longer. But it's very clear there's a drive for economic growth. There's a recognition that we need to have higher growth, higher productivity, greater investment in infrastructure, greater investment in UK equities, etc. If a lot of those are real assets, illiquid assets, areas of the economy that are perhaps referred to as productive finance, at some point you have to bridge the gap between the public equity markets and private capital. The investment company structure and those vehicles are the perfect way in which to do that and should be a key part of the answer. So I would argue very strongly this is actually the investment company's moment to be the solution rather than there being an existential crisis. But that's not to in any way belittle the challenge that many of those companies are currently facing because of issues around demand and some of the market issues that we talked about before and we'll no doubt touch on again.
Well, you mentioned Saba Capital. Let's talk about that, because obviously this has created a lot of headlines and certainly an extraordinary amount of comment and analysis by anybody who's interested in investment trusts. So what's happened is that Saba Capital, which is an American hedge fund run by Boaz Weinstein, has built up significant shareholdings in getting on for 20 investment trusts, I believe, and has just before Christmas requisitioned special meetings at which it will seek to replace the entire boards of 7 of these trusts. And to do that, it needs to win a majority of the turned out vote at a general meeting. So there are lots of issues here. First of all, though, I think it's fair to say that those 7 trusts, their discounts have all come in quite significantly in the last few weeks and months. And that is, one would say, almost certainly driven by Saba's involvement. So what is your general view about the activity of activist trusts? Are they not doing a good job for shareholders?
Activist investors, and we can talk about the specifics of this case in a minute, but activist investors have been in the market for many, many years, for as long as investment trusts have been around. And ultimately, their economic model is about identifying mispricing in the market and where there is an economic opportunity to therefore drive a return by seeing the closing of that mispricing. Clearly, there's an identified issue here with the discount relative to the net asset value, and a belief that by buying at a wide discount, if you can narrow that discount, you make an economic return. So, yeah, there are a reasonable number of activists investing in the market. There have been over the years. It's not a new phenomenon in that sense, and they're part of an efficient market, identifying those mispricing opportunities and helping narrow those gaps. And you're right, in the case of the Seven Trust concern, the discounts have come in as a result of the buying demand that's arisen from that activist's activities. So, yeah, they're a part of a functioning market.
Right. So would you go so far as saying that you actually welcome this development?
I don't think I'd necessarily say I welcome the development. I mean, I think there's a difference between looking to make an economic return and then using that to seek to replace boards and other things which are going on in this particular case. I mean, clearly it's for the investors in the companies to make their decision now. They'll vote at those general meetings. I think the key points are that they do get out and they do vote. All of these 7 companies have significant retail shareholdings on their register, and retail typically do not vote in large numbers. So it's vitally important that retail investors make their voices heard and consider the proposals that are in front of them. And that, there are a number of things that they should look at when they're doing that. The proposals as it stands are basically to replace the existing boards with 2 directors, one Saba employee and one Saba nominated director. That's the question in front of investors in the immediate term. But Saba have been quite clear in their letter to shareholders that they then have intentions to change the mandate of those funds, to replace the investment manager, to offer a liquidity event, to return capital, etc. So I think investors have to look beyond the immediate resolutions to say, are they happy effectively giving the 2 directors who would be appointed, if successful, the power to then go on and effectively do many of these other things, which wouldn't in themselves require further shareholder participation.
Yes, I mean, one of the interesting things about this is that Mr. Weinstein, he's made some public comments about how excellent corporate governance is in the investment trust sector in the UK. And yet he seems to be proposing now some things which would not be considered, I think, by most people, standard corporate governance in what he's proposing to do. It would certainly not be normal, I think, for good corporate governance to include the way that they are proceeding, though it is entirely legal what they're doing, of course.
It's certainly the case that a board of 2 would be relatively unheard of for an investment company. It's very small given the responsibilities of the boards. And to have one of those directors who is employed by a company that is potentially going to be proposed to be the future asset manager is also an interesting challenge, should we say.
Yes. Well, there has been a trend, obviously, towards demanding no representation from fund managers on boards, and that being one of the criteria for the best corporate governance, and what they're proposing would certainly seem to be in conflict with that.
Well, to be an investment company, it's critical that the board is independent of the investment manager. That's a key criteria. So, yes, that would have to remain the case in some way, shape, or form for them to continue to be investment companies.
Are you surprised or disappointed, perhaps, in the way that when Saba first appeared, they did seem to be very clearly saying they were doing what most activists do, which is they build up a stake, they approach the board, and in most cases they're looking for some kind of return, some kind of liquidity event, and therefore to make a turn, if you like, to make a profit out of that. And that's what, for example, I think it's pretty clear what happened with Elliott Management and Scottish Mortgage, to name one example. But they've changed their tune, haven't they? And they suddenly have come up with this latest idea. And talking to the chairs of the trusts, they all seem to have been taken somewhat by surprise by this development. But they have also found it difficult to engage with Saba, or at least they say they've not got very fruitful conversations with them. And to put out a requisition call just before Christmas with a short time frame and so on, that does appear to be out of the sort of activist playbook. You must find some aspect of that disappointing.
Yeah, I mean, I can certainly see from the board's perspective, it's very frustrating. I mean, you've got 2 of the 7 companies targeted are actually offering a 100% cash exit for shareholders at net asset value or a very small discount to net asset value. So you would argue that is that not what the investor would be asking for in terms of that economic return and closing that discount? So it's difficult to see in those instances what more boards could do in the face of responding to what the activist is seeking to achieve out of the process. And I think, investors need to think about whether the proposals from those companies, are they potentially threatened by the resolutions in front of them? Would Saba offer cash outs at similar terms or on a similar basis to the same quantity. And individual investors will also have tax considerations. So in both those cases, for those 2 of the 7 companies, there's an ability to roll over your investment into another open-ended vehicle, which means you wouldn't necessarily crystallize your capital positions. So individual investors, as I said, it's for them to make their own decisions, in part because they'll have their own circumstances to consider, tax considerations, etc. But those are all things that should be taken into account. I think the point you're making, and where I would concur, is that, and we talked about this just a minute ago when we were talking about the review back of 2024, the idea that in the face of activists appearing on registers, taking an interest in the sector, shareholders expressing frustration at the level of discounts, things, the idea that boards are sitting idle is just clearly not the case. Boards have been exceptionally active in the face of this and have been putting proposals on the table to shareholders. The level of buybacks, tender offers, mergers, etc. that we've seen have been at record levels. And even in the case of 2 of these 7, we're seeing the offer of a complete return of capital to shareholders if that's what shareholders want, regardless of the activist position. So, it's difficult to see what more boards could be doing in that context.
I think the 2 you're talking about here are Keystone Positive Change and Henderson Opportunities. I think those are the 2 that have offered cash exits. You are listening to a Moneymakers podcast. We are an independent research and publishing venture, and grateful to JP Morgan Asset Management for their generous, no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription newsletter, which provides a comprehensive summary of all the latest news, results, and performance data from the investment trust sector, with links to the relevant stock exchange announcements, and many other regular features, including more than 160 in-depth trust profiles, regular market commentary and videos, plus the editor's favorite funds. Never miss a thing that might affect your portfolio. So sign up today at money-makers.co. And thank you for listening. So let's just talk about this retail investor situation. Lots of aspects of this, but first of all, let me just ask you, do you think it is right that it is within the rules that you only need more than 50% of the vote by turnout for such a potentially significant corporate change of control issue, which is what Saba are effectively doing?
I mean, Saba are, from a technical point of view, they're looking to replace 2 members of the board, but clearly that will give them and one of their employees significant control over the company, as you say, by being one of those 2 directors and the other one being nominated by them. I mean, I think the principle of a shareholder democracy is one which goes to the very heart of UK corporate governance and UK markets. I think, a 50% majority of those who turn out is and has always been the way in which we've operated. I think the challenge here, actually, from a retail investor perspective is, and again, this is looking back in time a little bit, but investors used to invest name on register through investment direct schemes or whatever. There was a much more direct relationship between the investor and the companies they're invested in. You held paper certificates, etc. The invention of online trading platforms has been a fantastic development in the market in terms of enabling much greater access. We've seen retail ownership and participation expand exponentially as a consequence of that. It's much easier for people to do. But the consequence of that is that their relationship between their underlying investments and the investor is now intermediated. So you don't have that same direct relationship, and you therefore have much lower levels of participation in voting and corporate governance. And I think the challenge is how we encourage and engage more investors and get more investors to take that active interest rather than necessarily trying to change some of the rules. But it's an interesting question whether, certainly where it's fundamental in terms of a change of control provision or, there are other things. For example, in an investment company, if you were to change the manager, that doesn't require a shareholder vote necessarily. So are there other provisions that should potentially require a shareholder vote? Question. There's all sorts of things that we could look at that are not relevant, that immediate here and now, but are things that potentially require some examination going forward.
Yeah, no, what I'm thinking here is that I think there are lots of lessons that can be learned from what's happened. And I think investment trusts and boards should probably be learning those. I mean, I'm struck by the fact that you put out a very helpful guide to how you vote on different platforms, and some of the trusts that are affected have also done the same. But you might think, well, maybe this is something you should have done before because it's so important. It's turned out to be important. And a lot of investment trusts have actively sought retail investors, as you say, and they've lost that direct connection with them. A lot of them outsourced their share schemes to platforms and so on. So this is the kind of crisis we need, perhaps to lead to some kind of review of how investment trusts actually relate to retail investors and how these votes and so on are put in the rules.
I mean, our guide to voting has been out there some time. We've definitely highlighted it as a function of what's going on at the moment. I used to run a platform and we were very passionate about shareholder engagement and shareholder participation and voting. And the founder of the company I used to run, Gavin Oldham, was responsible for ultimately getting Part 9 of the Companies Act put in place, which enfranchised retail shareholders where they held their shares through a platform. The issue with that was it wasn't made mandatory. So platforms don't have to offer that. And typically customers have to opt in to receive those shareholder rights, for want of a better description. Now, we've seen some progress. Interactive Investor, for example, now automatically opt all of their customers in. And one of the things that I've done in the last week or two is write to the CEOs of all the various platforms and ask them to commit to writing to all of their shareholders in this instance, because the changes that are proposed are potentially so fundamental in terms of changing the nature of the investment that the investor holds. And the platforms have been good in making those commitments to write to and inform and set out for all of the shareholders of these companies, regardless of whether they're opted in to receive those shareholder rights, the details of these votes and encourage them to vote. So I'm hoping we will see much more significant retail turnout in these votes than we have perhaps historically seen.
I think it's just a mathematical fact, isn't it, that there will have to be a bigger turnout if the boards are going to resist what Saba is proposing.
Without question. And that's where everybody's attention is turned, I think, to making sure that shareholders should vote. And the key point is they make their voice heard and that they do so with an awareness of the potential fundamental changes to the underlying investments and the nature of the investment trust concerned if these proposals are successful.
So final question on Saba. One of the things they're proposing, or at least it appears they will be doing, is if they win control of any of these trusts, they have talked about creating a fund to pursue discount opportunities in the investment trust sector. As you say, there have been activists involved in the investment trust world for a long time, and some are still active now. I could put names to them, but I won't for this purpose. But would you actually welcome that as a development if Saba actually created a fund that was actively pursuing discount opportunities in the UK investment trust sector? Why would that be a bad thing if that's the outcome in these cases?
I think it's too early to say is the simple answer to that. I mean, I think a lot will depend on the actions that come following on from the words that are set out at the moment. You know, there's talk about potentially employing additional directors to make sure the board does become independent, about whether or not they will appoint Saba as the asset manager, about potential changes to the underlying assets and strategies of those funds. Yeah, I think we need to see how that manifests itself before we comment on whether or not that becomes a force for good or for other, I think, in terms of the sector as a whole. But as I said at the outset, is there a perfectly valid role for activist investors to play in the sector? Yes, and they've been playing that role for many, many years.
I guess there is just this, it seems to be disparity between the fact that they can get a 50% majority to change the board, but they can also block, because it requires a special resolution, the schemes that some of the boards have put forward for shareholders' consideration.
And that's what I said about the two, as you said, Keystone Positive Change and Henderson Opportunities Trust, where they've put potential schemes which deliver a return of capital at or very close to NAV. Shareholders have to think about, well, actually, are these potentially going to be thwarted by these proposals or not? You know, what's the prospect of actually delivering that? And will they get similar terms if Saba are successful in terms of taking over the management of the company?
So it's a complicated issue, let's put it that way. So let's move on. We've talked about Saba, and I would suggest it has been a wake-up call for a number of investment trust boards. You say the boards have been very active in the last year, but this has perhaps taken it to a new level, should we say?
And I think, let's be realistic, Jonathan. These 7 companies, it's vital that shareholders vote. It's vital that they make their voices heard and counted. But regardless of the outcome of those votes at the end of January, beginning of February, this is a longer term issue. It's not going to go away. Saba, as you said, have holdings in more than 20 investment companies. If they're successful, they will potentially be in control of and running some. If they're unsuccessful, they'll still be significant shareholders in those companies. So this has a way to run yet.
It certainly has. Let's then talk about something else, if we may, Richard. I don't want to go on at length about it because we've covered it so much, but it's still not resolved, and that is the cost disclosure issue. You mentioned that in the context of alternatives and their discounts being wider than those of equity trusts in the main. We know that there was progress back in September after the new government came in and they announced what's called forbearance for investment trusts, the way they disclose costs. And since then, we've had more developments, but I think most people have lost sight perhaps of where we are in this whole process, because we're still in some kind of limbo, are we not? We know what the current temporary regime is, but we also know that many investment trusts actually feel unable to comply with it in all respects. And we're still waiting for exactly what will replace it. So perhaps you could give us a quick update on where we are in this whole process and when it might be resolved.
So I won't linger too long on the current position because, as you say, we've talked about that at length in the past. I mean, I think that we clearly have the forbearance position in place at the moment. We have investment companies still producing modified key information documents, which potentially include a zero for further costs, but potentially still putting a cost into the European MiFID template, which is pulling through into the platform's disclosures and elsewhere, which is where a significant source of the frustration is, in part because the platform systems don't allow for the provision of the broader context, if you like. And ultimately, the platforms aren't going to redevelop their systems until they know what the longer term outcome is, if you like. So, yeah, there's a significant amount of frustration with the temporary position. I think one of the things which is clear in the temporary position is that fund-of-fund investors, other vehicles that are using investment companies do not have to pull through a cost. There isn't a requirement to aggregate. And that's clear in the exemptions that were granted from the relevant bits of PRIPS and MiFID. So that has been helpful in the temporary position, but I'll come back to that in a moment. So in terms of where we're at now, the legislation has gone through Parliament, and that has set out the basis and the scope for something called the Composite Consumer Investment Regime, which is effectively the UK's replacement for PRIPS. We love a good acronym in financial services. That's given the FCA the powers to effectively go and set the rules. And so the FCA issued just before Christmas a consultation paper on the new rules. And that consultation is open until the 20th of March. Clearly, we will be responding to that. We are, as a sector, in scope of the CCI regime, which is disappointing because we were arguing, as you know, to be outside of scope. But given that we're in scope in the regime, I think it's very important that, assuming we remain in scope, we end up with a suitably bespoke arrangement and recognition of the key features and aspects of the sector. Aggregation, which I mentioned a minute ago. So this is this idea that investors in our sector have to pull through some of their cost into their overall costs. Whilst that was resolved in the temporary position that we're in at the moment, appears to be coming back in within the new rules. And that's a real disappointment. That, for me, is the fundamental battle that we have to win in terms of the new rules. Bizarrely, there is a recognition in the rules for precisely the arguments that we make, that passive ETFs and index trackers and things would not have to pull through a cost. So if you're running a FTSE 250 tracker, for example, you don't have to pull through the cost of the investment companies because the investor is not paying that cost. It's not an additional amount that you're paying in some way, shape, or form for investing in that tracker. The costs of your investment don't go up and down just because an investment company comes in or out of the index. So it makes no logical sense. The reality is that argument holds for any kind of fund of funds vehicle. As long as there isn't a connection between the fund of funds operator and the underlying investment trust or vehicle that would cause you to effectively be able to game the system to make your costs as a manager look lower by corporate structuring, as long as that's not the case, there shouldn't be a pull through of costs at all. So we have to win that aggregation argument. And then there's lots of other things around the retail disclosures that are required. And fundamentally, the issue there is not one about disclosure. And a lot is made about this being cost disclosure and us wanting changes to cost disclosure. I think there's a recognition that investment companies incur expenses, the management fee being the largest, which investors should have an awareness of. I don't think there's anybody who would differ from that opinion. The issue is the way in which those costs are then presented and used within that distribution chain. So the idea that you have a presentation by an investment platform that says to an investor, your total cost in pound notes are the stamp duty, platform charge, and the 1% fee within an investment company turned into pound notes, and this is what you're paying, is just fundamentally misleading because the investor has bought that investment company at the share price. They'll sell it at the share price. There's nothing additional to pay in the same way as that they would have to pay stamp duty or the platform fee or whatever on top of their investment cost. So we have to get away from that presentation and this idea that at the moment, the way it's presented gives the impression to the investor that they have more or higher cost to pay on top of the cost of their buying the shares in the first place than they actually do. So there's lots of work to do still to face into that. We will be responding. I'm sure the industry will be responding in full. I know I've already spoken to others who've been very active voices in this campaign. And yeah, there will be a full-throated response, I'm sure, to the FCA's consultation to try and make sure we end up in the right place. The FCA have said, I think, they would like the new rules to be concluded by the end of the second half of next year. So we're sort of talking June 2025. You would generally then have an implementation period. So it will be probably well into 2026 by the time those new rules are operating. But if we can at least see the sense of direction and get some clarity around that, I think it will be useful.
Right. So there's a lot in there, isn't there? Essentially, you're saying investment trusts must have a bespoke solution because effectively they fall between two camps, and the FCI's historic desire to have a one-size-fits-all regulation has been a problem for the sector. I think that's fair to say. But you're also saying that it's clearly not sensible to say that investment trusts have 0% costs. You've got to recognize somehow that there are costs attached to it, but that it's not the aggregated costs that are required by the regime in the past.
And that those costs aren't in some way additionally payable by the investor. They're costs that are incurred within the investment vehicle that impact return and things, obviously, but they're not paid additionally by the investor. They're not going to somehow be taken out of your account on top of what you're paying to buy the shares. I mean, there are some good things in the FCA's consultation. There's a recognition, for example, that those cost figures shouldn't include the operating costs related to real assets, for example, where an investment company is investing in real assets. Those should be taken out, that gearing costs shouldn't be included. So there's a recognition of some of the key points we've been making, but there's undoubtedly more work to do.
But the one outcome we don't want, or you don't want, I should say, well, as an investment trust investor, I don't want it either, but the one outcome we don't want is that we actually revert to some kind of form within the CCI umbrella that goes back to something like the status quo ante.
And I think if you go back to the origins of this debate, the issue really was the fact that fund-of-fund vehicles, wealth managers and others were having to pull through a cost into their OCF, which made their products and others look more expensive than they were to the end investor. And therefore that made their investment, or the idea of them investing in investment trusts, using investment trusts within their portfolios, unattractive. And they decide to invest in an investment company at the share price, for all the reasons of discounts and things we were talking about earlier and yield and everything else. They make that as a value judgment. There isn't a cost that's paid by the investor that should be pulled through to somehow inflate that percentage charge that the investor is seeing for that product. And we need to get away from that concept. And that, for me, is the key battle, because if we're successful in that, and we have been in the temporary position we're in at the moment, which was heartening, therefore that's why it's so disappointing to see that kind of reversed within the consultation. But if we can win that battle, then that will help restore demand from that particular part of the market, and that's vital.
The final comment I might put on that would be, I guess then the onus is on, well, you and the investment trust universe to demonstrate that actually these cost disclosures have actually limited demand. Because you think that sophisticated investors should be able to look through all that. They know what life really is. And it would be interesting to know when we can get some empirical evidence how damaging this cost disclosure regime has been.
I don't think it's a case of sophisticated investors. Perhaps I didn't explain myself well. I don't think it's a question of sophisticated investors not understanding the costs and the value debate and where that balance rests. If you are a fund-of-fund manager and you want exposure to renewable energy infrastructure or something, for example, do you invest in an investment trust, which is going to give you diversified, actively managed exposure to that asset class? Or do you invest in a trading company that potentially SSE or something that has some similar exposure to that asset class, but clearly comes with different risks in terms of single company risk, operating risk, etc.? Now, if I'm the fund-of-fund product manager or the asset manager, and I'm looking at those two possible investment choices, with one, I'm going to have to pull through a cost, which is going to make my product look more expensive when I try and sell my fund to investors. And with the other, I don't have to pull through a cost. So I'm going to invest in the one potentially that makes my end product look cheapest. And that's disadvantageous for the investment company in that comparison, when in reality, I'm buying both. As the investment manager, I'm buying both at a share price and I'm selling both at a share price.
That's what I mean. So they see that as a perceived problem when they're talking to their investors rather than themselves, yeah. So finally then, Richard, it's been very interesting. Let's talk about 2025 and what your hopes and aspirations for 2025 are. If we talk again in a year's time, I guess you've got a wish list of things that could happen. We've covered most of them. You hope that the costing are being resolved. You'd hope the discounts have come in, and you hope that interest rates are coming down. That would all be very, very good. Anything else on your agenda?
That's pretty much my list to Santa, I think. Yes. No, I mean, that's clearly the focus of our attention. I think the AIC's agenda is very much centered on getting that resolution to the cost disclosure debate during the course of the year, in the immediate term dealing with the activist investor issues and some of the challenges that presents, but also, as you alluded to earlier in our conversation, thinking about and looking at the structure of the market and any particular governance issues and things that brings to light in terms of other things we should be campaigning for in the sort of broader regulatory sphere. Clearly, it would be nice to see discounts come down, and interest rates coming down might help that a little bit. Although, as we said earlier, that perhaps looks a little bit less likely, certainly less likely to the level or to the extent that we were perhaps hoping for last year. But yeah, that's basically the wish list. And I think then beyond that, in terms of our activities, very much about promoting the sector. And, I know, as you said earlier, there's been a lot of press coverage of the Saba events in all of the mainstream media, and our press team's been very busy helping make sure that that's the case. But a lot of the coverage from journalists has actually been very positive about the sector, about the important role the sector plays for investors and the recent performance, etc. So I think a lot of the tone of that is very positive, and why investors should be looking to support the sector. So our challenge as a trade body, as a sector, is to make sure we're on people's radars, to be as prominent and visible as possible, and to hopefully drive demand as a consequence. There's a broader issue that it would be nice to see some progress made on in 2025, which is around the UK equity markets and just revitalising those UK equity markets. We are an important part of that. We're close on a third of the FTSE 350. And it would be great to see the LSE, the government, others really getting their shoulder behind the wheel in terms of revitalising stock markets, talking much more positively about public equity, mass participation in equity, and what that means in terms of ISA reforms or pension reforms, in terms of encouraging investment into UK equities, etc. Other things that we will be having an eye on in 2025 as we go through this year.
I was going to suggest that actually pension funds investing, or DC pension funds, or with the ability to invest in investment trusts and so on, or IFAs and all the rest of them, that would be a potentially significant change given how small their exposure to UK equity market is at the moment.
Exactly that.
Okay, well, on that note, I say thank you very much, Richard. There's been so much to talk about. And as you say, I guess the big positive is that investment trusts have made the front pages occasionally of the newspapers. The best kept secret perhaps is not as secret as it once was. But we'll all hope that it all ends. Thank you. So thank you very much for your time today.
No problem at all, Jonathan. Thank you. And yes, we have to make sure it's no longer a best kept secret. It's the best thing on the stock market, and it shouldn't be a secret.
Exactly so.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. Please note that podcasts are provided for educational purposes only, and nothing you have heard from any speaker should be regarded as constituting investment advice. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.